Good morning. Welcome to Trading Hour. It's a Wednesday morning. It's 11 o'clock. I'm Reema Tendulkar. With me, Sonal Bhutra, and markets consolidating for the second day in a row. Absolutely flat on the Nifty, Sensex, and the mid-cap index, but the small-cap index continues to see a fair amount of buying, like yesterday. So yesterday, the small-cap index ended with gains of about 0.8%, and it's followed it up with another near 1% rally, and that's pushing the advance decline ratio firmly in favor of the stocks advancing. A quick word on the picture across the Asian markets. Well, it's a mixed picture. So China's up, Shanghai is up nearly about 0.5%, but the economic data from China continues to be fairly muted. So China's industrial profits are down 10% in the month of October, and this follows a 27% slump that it had in the prior month. So yes, you would say that the picture is not as bad as it was in the month before, but still, the little bit of a stimulus, hasn't shown up in terms of the economic picture. Investors will closely monitor the U.S. core PCE figure, initial jobless claims, and the GDP first revision today before they head into their Thanksgiving holiday on Thursday. So it's a mixed picture across Asia right now. Shanghai is up, but Nikkei, Taiwan, Korean markets, these indices are currently in the red. And back home, CPSE continues to do well. So the PSU is in top form, 3% higher in the last 3 days. And IT has gained for the 6th consecutive day. The gains are not much, but it's still a gain. Hi.
Oh, yes. And it's a consolidation, and tomorrow is the monthly expiry. And after that, we start the December series. And so far in this month, we've seen Nifty being absolutely flat. There is no movement whatsoever. We've seen, of course, those down days, but there has been a massive recovery from those lows as well. There you go. So it's absolutely flat in the last 1 month. The Nifty, that is, at the 24,200 mark. A lot of sectoral movers, of course. The CPSE index, that's in focus, 1.1% higher. That's the top gainer. Reema spoke about the small cap index that continues to do well, but it's largely a day or the theme of consolidation after the rally that we saw, and that could continue. We'll have to see which way things go, because as I said, tomorrow is the monthly options expiry, and that will be very, very important to track for our own markets. Then we have around 45 new F&O stocks that get added in the December series. So a lot of individual stock action. And when we talk about individual stock action, we have to talk about M&M, because Mahindra Group has deepened its electric vehicle bet. It has launched 2 new electric SUVs promising faster charging and higher mileage at an event in Chennai. Parikshit is joining us with more details on this one. Parikshit.
The Mahindra Group is targeting a big chunk of the compact SUV space with these 2 new electric vehicle offerings. This is the XEV9e from the XEV brand under the Mahindra Group. This vehicle would cost you around 23 lakh rupees on road. On the other side, you've got the BE6e. Now, the BE6e is from the B brand under the Mahindra Group, and the cost of this car is 20 lakhs on road. These are very compelling prices because most cars in the compact SUV space, such as the Creta, the Kia Seltos, the Ertiga, all of them cost around 20 to 21 lakh rupees. This is a 44,000 per month market, and the Mahindra Group believes that in the long run, it can win a large share of this market with these 2 electric vehicle offerings. You get 2 battery pack options. One would be a 59 kilowatt-hour battery pack. The other is a 79 kilowatt-hour battery pack. Both of these can give you a range of over 500 kilometers in a single charge. In terms of charging, you can charge both these vehicles at your home overnight, and in about 8 to 9 hours, you'll get 100% charge. Using a fast charger, you can also charge your car up to 80% in 20 to 25 minutes. This is what the company is claiming. A lot of advanced driver assistance systems in the car. You've got very luxurious interiors resembling a fighter jet in a way. In fact, the console, the top console in the driver's cockpit resembles a fighter jet as well. You get 16 speakers, 5G connectivity, Qualcomm chips to support high-level AI applications in the car. So a lot of technology, a lot of software, and the company is betting big on the future, on electric vehicles with these offerings.
Wow, swanky looking cars there, competitively priced. That's M&M for you. But, rich in features, as Parikshit was pointing out. Sudarshan is also joining in with what brokerages have to say about these new launches and whether they're as bullish. Sudarshan.
So amongst all the features that Parikshit was talking about, these 2 electric vehicles that M&M has launched, one feature that now has attracted the most attention is the price. company has given the price range of rupees 20 to 23 lakhs, and it's all the brokerages are finding it very attractive. So take a look what does MS say. It says models are high on performance and feature rich, and prices are in line with premium variants of best-selling ICE models. ICE basically petrol and diesel, but off-tech will be key to watch. Goldman Sachs says these two models will help company address segments totaling 85,000 units per month. Elara says company has done all that it takes from their side. It's for the category growth to pick up in India, and company has earmarked a capacity of 10,000 vehicles per month for EVs in FY26, which is higher than the size of the entire Indian EV industry currently. Nuvama 2 is positive. It says company has unveiled feature-rich electric vehicles at competitive pricing, and it will support growth going ahead. Currently, it has built-in EV volumes of 48,000 units in FY26 and 96,000 units for FY27. And these estimates form 8%, 15% of domestic utility vehicles respectively, and it estimates 15% revenue CAGR for M&M over FY24-27. Investec says few standout features that it has listed out. First, company is providing lifetime warranty on these electric vehicles. Second, 3-in-1 integrated powertrain that company has come out with. And next is fast charging capacity that these two electric vehicles will have. And it says price range is equivalent to 40,000 units per month of ICE vehicles sold currently. And it's attractive, and it could aid in increasing EV adoption that company will have in country going ahead.
Okay, so that is about M&M. Thank you for bringing all these details. But Sudarshan, you're also tracking Ola Electric. There's been a big surge in that stock. There's a positive note from Citi. Give us more details.
So before I talk about the positive note, that yesterday company had come out with new launches. It has launched a wide range of scooters, and company is going to bring those models in the market next year. Now, Citi has today come out with a note. It has initiated coverage with a buy call, and target is rupees 90 per share. As per Citi, positive thesis on first, company has a wide product portfolio. It has strong R&D, and third, it has significant vertical integration, and it has a large scale of production. And Citi says soon to be launched motorcycles and electric three-wheelers as well will boost volumes for Ola going forward. Another key risk, you can say, Citi says service perception has been negative of late, but it may subside in medium to long term. It also expects profitability to improve as capacity utilization increases. It has listed out key risks as well. First, overall weak EV penetration. Second, elevated competition. Third, continued negative perception on service quality. And fourth, sustained net losses that company has been reporting. On the valuation front, it has used sales-based valuation methodology, as company is yet to break even at EBITDA level, and target prices based on 4 times FY26 estimated EV purchase. And Citi says premium for Ola, it makes premium as it dominates fast-growing segment with attractive prospects. So overall, Citi is very positive on Ola Electric, and you can see in the stock price today as well. Stock is trading with a gain of almost 12 to 13%.
Thank you very much for that. I'm also watching for LTI Mindtree. Now, yesterday they held an analyst meet, and the key takeaway is that the company set out an ambitious revenue target of achieving $10 billion of top line by 2031-2032. Now, this compares with $4.3 billion of revenue that they achieved in FY25. Now, they're saying this is going to be organic. If a strategic acquisition happens, it will be opportunistic, and that will be over and above that. Now, they will achieve it by focusing and scaling up their key verticals like BFSI and high-tech. They want to double them, but they're also looking at increasing, manufacturing, resources, healthcare, life sciences, and consumer verticals. There was a lot of time spent on AI. There's a clear strategic pivot to AI. They're talking about AI in everything, everything for AI, and AI for everyone. They also want to mine their Fortune 500 clients better. They have presence only in 105 clients, so they want to expand that and make some deep inroads in that. And also to achieve their margin aspiration of 17 to 18%, the company said double-digit revenue growth would be critical. About the near term per se, the company said discretionary spend has not returned as of now. But given that US elections and that uncertainty is out of the way, clients will be finalizing their budgets in the coming month. So that's LTI Mindtree, $10 billion of a revenue target by 2031, 2032.
Okay, all right. So a lot of targets that we've been getting from managements recently, right?
It's just that the stock is not reacting because one, it's expensive, relative to peers, and generally IT has done so well in the last 3 months. So LTI Mindtree was always the more expensive one compared to peers, and then it post the rally.
It's in the price.
And two, it's also a target which is set very far away. You'll have to watch for the execution, through the course of the year instead of just jumping at it today.
Yeah, it'll be too soon to do that anyway.
Too soon to do that. And plus, of course, as I said, this is one of the more expensive IT companies.
All right, take that point. Thank you for explaining that to us, Rima. But we'll slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Stay tuned. Welcome back. You're still tuned into Trading Hour. Well, it's time to talk about the commodity space. There's a lot happening there as well. Manisha is joining in, and today we are focusing on copper. Manisha, what's happening here?
Well, yes. Across metals, there has been a bit of a buying that has come back in. The last 3 or 4 sessions were not so great, but we're looking at copper prices now off its 11-week lows. The support comes in quite strongly. Copper actually has seen a decline of 6.5% in the past 1 month. So there is a bit of a buying on your screens, as you can see. Well, US has announced 10% of tariffs on all Chinese goods, and that can weave its way into the prices there. That is one. The second thing is that November and December are seen as peak China demand seasons, and that has been supportive as well. And then with the way the data is from China, there's an expectation that you could be looking at a stimulus measure coming in from China pretty soon, and that has been supportive. Not just copper, zinc gained up by 2% overnight, and that is because there has been a sharp decline on LME inventories onto that one. Aluminum, in any case, continues to be the best performer in last 1 month or in this year until now. That is because of Russia's Rusal says that they are looking to cut 6% of aluminum output. That is because the input cost is higher, the profit margins not as much. We already are looking at high alumina prices. Bauxite prices also at near all-time highs. There are supply concerns from raw material coming in from Australia and even as countries like Guinea and Brazil, and that could be supportive for aluminum prices going forward.
Okay, thank you very much for that. We will slip into a very short break. We'll come back and discuss market technicals. Mitesh Thakkar joins in with his top trading bets. Welcome back. As we've been highlighting, the small cap index continues to do exceedingly well. That's up close to about 0.9%. And one of the stocks on fire is Sagility. Now, Sagility was up nearly 10% yesterday. It's followed it up with another 4-5% move. And this up move in Sagility comes on this 2-day gain comes on the back of its numbers, which came out on Monday. So Monday post-market hours, we had the numbers, and Tuesday and Wednesday today, we are seeing that rally. Remember, it's a recent listing, listed only on the 12th of November. It was a very muted listing. The issue price was 30, and after this 15% gain also, it's somewhere around that 33 rupee mark. Now, just a quick word on what this company does. Well, this is a company which provides tech services to US healthcare companies. So largely about 85-90% of its revenues comes in from the US health insurance companies. And for these companies, the US health insurance companies, they provide claims management, enrolling, premium billing. So that's the kind of services it provides. Now, why is the stock higher post numbers? One, the revenue growth has been ahead of what we've seen in the past, 21% up on a year-on-year basis. Last year, FY24 revenue growth was only about 12.7%. So there was a pickup in revenue growth. Secondly, margins for the company are in line with historical levels. So on a sequential basis, you're seeing a big jump. But remember, Q1 was depressed because of exceptional. 22.7% margins is similar to what we've seen in the past. Even FY24 margins were about 22.9%. But, there is a big jump seen in the company's profitability, both quarter on quarter and on a year-on-year basis. And that's the reason why 2 days of gains for Sagility post, the Q2 numbers, because there's a pickup in the revenue growth and the company has managed to maintain its margins despite the pickup in the top line.
So that explains the move. And this is a new listing, so we can talk about Q2 numbers, but earnings are still trickling in. So even the next stock that we are going to talk about, it's going to be on the back of its earnings. Siemens surging in trade, the margins, EBITDA, net profit, beat estimates in the quarter ending September 2024. Vivek is joining us to tell us more on this one. Vivek.
Well, that's right. So Siemens followed the September year ending, and it was the last quarter, which is why, they got the extension to go ahead and report their numbers a little later than other companies. So like you mentioned, most of the parameters are largely above what the street was anticipating. Revenues in line to a slight miss. Profitability aided by much higher other income component this time around. Now, talking about the revenues, higher by 11% on a year-on-year basis, EBITDA up 34% on a year-on-year basis, and EBITDA margins on a year-on-year basis has expanded 250 points, clearly indicating the kind of operating leverage benefits that the company is actually enjoying. Talking about the segment-wise performance, energy mobility was better than estimates. Smart infra, digital industries slightly lower than what the street was anticipating. New orders, that is something that's quite strong. Order book too quite strong. So new orders at over 6,100 crore. This is up 37% on a year-on-year basis. This is excluding the one-off item as far as the base quarter was concerned of the large HP locomotive order. So now, along with the result, the company said that they're committing additional capex of close to 100 crore for the power transmission transformer factory in Kalwa. They're saying that they're looking to expand the range of the product portfolio over there. And lastly, key to watch out for will be the demerger and the separate listing as far as the energy business is concerned, and whether any stake sale happens over there. That is what the management has said, that the next focus priority for them is that particular energy business delisting or demerger.
Okay, all right. Thank you so much, Vivek. So that's Siemens up around 2.5% in trade today. Let's slip into a short break. Up next, we'll discuss the market fundamentals with Varun Loja from HDFC Securities. Stay tuned for that. Welcome back. You're still tuned in to Trading Hour on CNBC-TV18. A lot of stock-specific action is happening, so let's talk about that. Prestige Estates is one of them because there's this downgrade that has come in from Morgan Stanley. The stock is down around 4.5%. The stock has been downgraded to an underweight from an overweight. The target price has been cut to 1,510 on the stock by Morgan Stanley. They say it was a 63% pre-sales growth in FY24. It's been one of the best growth story in the real estate space as well. However, they're now reducing their FY25 pre-sales growth estimates to 9% on a YY basis versus earlier 28%. Because remember, the company has been able to achieve only 29% of their FY25 pre-sales target. They have it around 24,000 to 25,000 crore rupees, and they've only achieved 29% of it in the first half, and there have been delay in getting approvals, and first half overall has been weakish for the company. The relative underweight rating is a function of high capex on the business and weaker pre-sales momentum versus peers, because Prestige has so far been outperforming the industry, but this is the first time that an underperformance has come in on Prestige, and that's why Morgan Stanley seems to be a little bearish on the stock, and that's why this downgrade and the target price cut.
That is Prestige for you. Talbros, on the other hand, is in focus after winning multi-year orders worth 475 crore rupees along with its joint venture partners. Sudarshan is back with us for more details. Sudarshan.
So stock is today buzzing in trade. It's up almost 11% and it's on the back of large order wins. Company has bagged multi-year orders worth rupees 475 crore along with its joint venture companies. Remember, earlier to this in H1 FY25, company had received orders of rupees 2,000 crore, and about this huge order, company had mentioned in its Q2 results that it's expecting a huge order from an OEM, and now those orders have come. Commercialization for these products are expected to start in FY26, and these orders that a company has received of rupees 475 crore will be executed over next 5 years. In the Q2 earnings, company had also talked about the outlook, in which it mentioned that Q3 might be slightly muted, but there might be a sharp improvement that company is expecting in Q4. Also, it has maintained FY27 turnover target of rupees 2,200 crore. So overall, on the back of today's order wins, companies like stock is reacting positively.
Okay, all right. Thank you, Sudarshan, for that. By the way, important flashes at the bottom of your screen. Adani Green has released a press note which says that Gautam Adani, Sagar Adani and Vineet Jain are not charged with the FCPA violations. And on the back of this, the stock has surged. Actually, it is at the day's high. So there is an important clarification coming in. FCPA, of course, is Foreign Corrupt Practices Act. And we keep getting more clarifications coming in on this from the company as well. But for now, the stock is taking note of this clarification that has come by, and we'll keep getting you more details on this one as well. But we have a market conversation that we need to go forward with. Varun Locha from HDFC Securities is joining us now to discuss market fundamentals. Varun, good morning. Thank you so much for joining in. Well, you know, most of quarter three, 2 months of quarter three are over as well. What's the sense that you've been getting now in terms of your conversations with corporates? Because quarter two did see a lot of earnings downgrade. Are things improving now in quarter three? And which sectors are seeing better improvement?
Yeah, good morning. So quarter two and actually even quarter one was fairly weak, and we saw downgrades in both the quarters. It's just that market was in a bullish phase in Q1, so it ignored the weak earnings. So first half, we have seen around 4 to 5% downgrades. We were anyway way below consensus at the start of the year. You know, we were forecasting only 6 to 7% growth for this entire financial year, which has now actually got further downgraded to around 3%. Q3, we believe, will be better than Q2 because of 2 or 3 reasons. One, I think the expectations were running too high, partly also because of analysts, penciling in very sort of generous numbers because of stock prices moving up. So what tends to happen in a very strong bull market, analysts tend to overestimate earnings because they need to catch up their target prices with the stock prices, and therefore, the moment we see a bit of slowdown, the downgrades seem to be, sharper than what the actual slowdown is. And secondly, the base will get better in Q3. If you look at Q2 also, ex OMCs, the growth was around 9%, and the base for OMCs will get better from Q3. So for second half, we are expecting around 7 to 8% YOY earnings growth for our coverage universe, which is better than what we saw in the first half of the financial year. And also, festive season has been reasonably okay. If you look at, some of the select pockets like consumer durable, most of the companies have talked about a good festive season demand. Among the automobiles, especially two-wheelers, have had a reasonably decent festive period. Jewelry demand was also reasonably good. So we don't think there is a all-round big pressure on consumption also the way it is looking at the Q2 numbers. The problem is in select pockets. Problem is at mass consumption items in urban. So urban middle class and urban poor is where the impact has been high of the food inflation, and that will take few months to sort out. But barring that, both rural as well as the top half of the urban population, they seem to be quite okay in terms of consumption. So second half to be slightly better. Valuations have corrected, so I think that now again starts to provide some upside at an aggregate market level over a 6 to 12-month period. But it would still be a fairly muted sort of a return and very stock-specific market, and not a broad-based all-out rally the way we saw in the previous 12 to 15 months.
Hi, Varun. Just a few quick questions on what you said. One, H2 earnings growth is 7 to 8%. What was the comparable number for H1?
So H1 was actually close to 0 to -1 for our coverage universe.
0. Okay,
So
and you also said
full year number of around 3.5-4%.
3.5 to 4%. Got it. And you also said that the urban poor and the urban middle class is where we've seen stress, particularly consumption stress. So if in terms, in terms of actionable ideas, how would you play this? Because rural is doing well, so rural consumption. So how would you differentiate, and which would be the impacted stocks?
So see, there are again a few more nuances to it. If you look at FMCG, there is also an issue of quick commerce impacting them because of fragmentation, and there is a share of wallet issue with FMCG, that more and more spends are going toward discretionary items. So right now in consumption, we are preferring, consumer discretionary over staples at an aggregate level. So we are positive on, consumer durables. We are positive on select, apparel names as well. We are positive on liquor stocks. We are positive on select FMCG, but overall, as FMCG as a basket, we are underweight because we believe, the issues of growth will continue to, especially quick commerce in urban will continue to impact their growth. But you have to be very, very stocks selective. Something which is very exposed to rural might continue to do better in second half. So we have names like Imami, Dabur, where we have a positive rating, even Marico for that matter, within staples. So it's very stock specific rather than getting overly bearish on consumption at this point of time. We have two-wheeler stocks in our model portfolio. We continue to hold them.
Oh. I remember in the last conversation, I think you had said that you were underweight on mid-cap and small-cap IT. This was about a couple of months back. Has that view changed? Because IT has gotten re-rated in the last few months.
Not really. We are not increasing our weight in IT sector. We have, we had cut from underweight to neutral almost 3-4 quarters back, but it was largely in the, in the larger companies rather than getting into the small and mid caps in IT, because their valuation seem slightly more stretched compared to even the growth improvement that we are seeing. And we don't expect that IT will go to double-digit growth anytime soon. At an aggregate sector level, there will always be few stocks which will be doing that. But we believe as the domestic demand comes back in second half and FY26, IT will probably start to look less attractive on a relative basis, going forward. So we are not increasing our weight in IT sector.
Okay, all right, Varun, thank you so much for joining us with your thoughts and idea on overall markets and specific sectors as well. That's the word coming in from HDFC Securities on overall markets. But time for a short break. When we come back, we'll discuss what's been the story of the day and been the story for last couple of weeks as well. Sachin Gupta from CareEdge Ratings along with AM Karthik from ICRA will join in to discuss the tighter lending norms for microloans and what's happening in the microfinance institutions. Stay tuned.
Welcome back. Now, the big story over the last 24-36 hours has been on the microfinance industry. So the Microfinance Industry Network, we call it MFIN, has prescribed another set of stricter norms. So one of the key, provisions or, aspects is reducing the number of micro lenders per borrower from an existing 4 to 3. Now, these new measures will come into effect only from the 1st of January 2025. So there is sufficient time for regulated entities to implement the changes. But how will it hurt? How will it impact all these microfinance and stocks and companies? Sachin Gupta, Chief Rating Officer and Executive Director at CareEdge Rating, along with AM Karthik, Senior Vice President and Co-Group Head of the financial sector at ICRA, is now with us. And both these two gentlemen and their companies have actually downgraded their assessment on Fusion Finance. So ICRA has downgraded its rating on Fusion Finance, while CARE has placed the long-term bank facilities of Fusion Finance on watch with negative implications. So they pretty much singled out Fusion Finance as a company, which gets negatively impacted by these developments. Sachin, let me come with you. Why Fusion Finance? And tell us, what did your analysis throw up?
Hi, thanks. Thanks for having me here. As a rating agency, we continuously look at companies' performance, and it is not that we have singled out a particular company to kind of take a rating action. In general, we are clearly seeing a stress building up in the microfinance. In fact, we came out with a report last week where clearly we are saying that there is stress. And in fact, the recent guidelines which have come out, which you mentioned of MFIN, that will further exacerbate, at least in the medium term, the stress on the microfinance institutions.
Okay, all right. Thanks for your views, Sachin. Karthik, come in on this. If you can tell us how would these regulations impact the companies in the sector? And generally, how do you see this trend going forward? Do you think these regulations will help, or there's still much more pain left?
Hey, hi, good morning. These regulations on the long term is going to be very helpful, but in the medium term, we would expect some stress to flow through, both from a growth point of view. One, we would see an increased amount of rejections from an onboarding perspective. We would see slower growth, and our estimate is about 20-25% of the overall microfinance loans are falling under this category of where they have more than 3 loans. So when you're talking about a 20-25%, that's a quite sizable number, where incremental credit flow to these borrowers are going to be slower than what it was in the past. So some of the weaker borrowers within this category, 20-25%, could slip forward. We are already seeing stress. The overdue in the sector is, as high as about 16%. When I say overdue, I'm talking about, one installment overdue and upwards. When you bring this additional constraint of not extending loans, it is possibly going to impact loan quality, at least in the near term. But it's a good step where one would see stronger underwriting, better quality borrowers coming through, and assessment being largely towards good quality customers thereon. So it's a good step in the long term.
So, Karthik, I take your point, sorry to interrupt. I take your point that these measures are positive over the longer term. But you said that 20-25% of the industry size, the borrowing that's currently there, is likely to get impacted. So what is the number that we are looking at in terms of rupees crore? That's point number one. And even in terms of gross NPAs, in the near term, asset quality, do you have any kind of analysis of, how much the gross NPAs could shoot up?
So we don't have a number outhand, but when I say 25% of the borrowers, there are about 8 crore borrowers in the microfinance space. So 2 crore borrowers are the ones where there is a likelihood of more than 3 loans being taken. The previous guideline, which was about 4%, 4 loans plus, that was about 13 to 15%. So when that goes up to 20-25%, so you're seeing an additional 10% of borrowers not possibly getting a, credit subsequent to this new MFIN guideline. In terms of quantum, it will be difficult to put a number, but the MFI sector overall is about 4.2, 4.3 lakh crore. So 25% of that would be about 1 lakh crore or so. But not everything is going to be stressed. There are possibly only the weaker borrowers within this space. And since these regulations are coming in a very gradual and a graded fashion, we saw the first movement to 4 borrowers and 4 lenders, and now to 3. So the impact will not be too high. We should not expect that all of this cohort of 2 crore borrowers or about 1 lakh crore is going to be stressed. But we would see an increased flow going forward because cash flow to these borrowers would be slower than what it was in the past.
Okay, all right. Sachin, comment on this. Do you think if it is a medium-term negative and this stress could continue, we could see some consolidation in the sector? And specifically on Fusion Micro, since there's been a downgrade by both the agencies, what's specifically making you very bearish on this name? What led to this downgrade out of all the lenders that we have seen?
Yeah, thanks. So, as Karthik mentioned, there is clearly a systemic stress across the space. And yes, the consolidation is a possibility. In fact, we believe that some of the entities, especially on the smaller side of the size of microfinance, they may not be able to get access to bank funding or even equity funding. And if that happens, they may have to reconsider their business models in terms of whether they really lend on the balance sheet or they maybe become more like agents to larger MFIs. The specifically coming to Fusion Microfinance, as I said, it is more of a sectoral thing. But yes, in particular, we are seeing high credit losses there, which is kind of clearly a factor which is impacting the rating. Also, because of these guidelines that have come out, in general, there will be increasing delinquencies in the next 1 or 2 quarters as well. Because you have to understand, that the typical borrower of MFI is, bottom of the pyramid. And once the disbursements from the whole system kind of come down, there will be less access of fresh funding to this segment. And therefore, people who are trying to really, take additional loans to fulfill their existing loans, that option is not there. And that is in fact the intent of the whole MFI, and that they're trying to isolate the problem. They're not kind of giving more money to restrict or to improve their credit quality, but rather restricting the cash flows, and therefore the delinquencies will go up. And with that, our outlook overall on the sector is negative. And yes, the consolidation is likely. One critical thing would be the access to capital. So because all these companies, when they are looking at high delinquencies, high provisioning, therefore high losses, therefore impact on their net worth, what we really have to see, the microfinance institutions who will be able to raise equity will be the ones who will be able to survive it better. If there is no access to fresh equity and limited access to bank funding, those entities could be facing a bigger challenge. Just since you mentioned Fusion, they have announced a rights issue, I think of about 550 crores. So that's a mitigating factor, even though the performance on the operating parameters was weak.
Karthik, one quick question. Is there a risk of downgrades for the other MFI companies like a Credit Access Grameen, Spandana Spurti, Muthoot Microfinance? Have you studied them? Do you track them? And is there a risk?
We track all entities on a regular basis. It will be difficult to talk about individual entities unless something we come out with a formal communication. But we are tracking the sector as a whole. We do understand there is stress, and as indicated, capital is something that we are looking out for. Entities with stronger capital are and relatively lower stress. I think the stress is going to be higher than what it was in the recent past. So it will be higher than what we have seen. But the question would be on the ability to, manage this stress and come out. So we would, see some entities wherever the leverage is higher to face increased stress, as indicated. Capital is something that we are closely looking out for. Entities do not need capital per se in the current scheme of things, but additional capital always is helpful and giving comfort to the lenders. So we are looking at all entities. We will possibly take a measured call in terms of which entity is, possibly going through a higher level of stress.
Okay, all right. So we'll watch out for those rating actions on different companies. But Sachin and Karthik, thank you so much for joining in today with your take on what's happening in the microfinance sector and the new regulations as well. Time for a short break now. We'll get you more on the markets on the other side and a lot more. Stay tuned.
Welcome back. BEL gets top honors even today. It's a 2.7% rally on BEL. This week, in 3 days, the stock is up nearly 9%. So buying continues in the defense names. Remember, yesterday, JP Morgan initiated coverage. They're saying the stocks have corrected from their recent highs. For BEL, the lifetime high was 340. So even today, it's about 10% off from its recent high. The order book is strong. It's a structural story. So JP Morgan initiated coverage. They're saying after the fall, the valuations are far more palatable, and they put a target price at 340 on BEL, which is the lifetime or the 52-week high on BEL. Remember, this is a stock which has done exceedingly well. I think in the last 3 years, it's given a return of about 360%. So that's about BEL. For the markets per se, things continue to be very, very quiet, just down about 22 points on the Nifty. We're going to wrap on trading hour. We'll take your leave. Thank you for watching.